This is the Eagle Investing Network, and I'm Jerry Bowyer. People have been asking me a lot about hyperinflation, and they've asked me whether they think that's what's going to happen. Well, yeah, I'm sure that's what's going to happen. Someday, in the future, every paper currency eventually has gone down to something like zero, but I don't think that's what they're really asking. I think they're really asking whether it's going to happen in the foreseeable future. Could be. Let's talk about why or why not. Let's go to some data. People are obviously interested in the topic. Historically, there are very few Google searches on hyperinflation, and we can see a lot of them have happened in 2021. It's down a little bit and then came up a little bit after this. So hyperinflation is certainly a topic that's on people's minds. The question is, are we actually going to have hyperinflation? Well, first, let's see whether we have that in the inflation expectations that are in the market. This is the purest expression of inflation expectations. This is the difference between a regular 5-year Treasury yield and an inflation-protected Treasury yield. So in the one case, you get compensated for inflation risk through a higher interest rate. That's the regular. In the other case, you get compensated for inflation. At the end, when you get your money back, you get your principal back, they give you a little extra to compensate for the inflation. So the inflation compensation isn't in the interest rate. So the difference between those two interest rates is the inflation expectation. And it certainly has been going up, but it's been going up from 1.5 to something a little bit more like 3 or 4. Now, I don't think this is as high as reflects the reality. I mean, obviously, we're already higher than this. And there are some reasons why tips don't fully capture historically the inflation expectations. But we're still nowhere near hyperinflation. It'd have to be 10 times this in order to be hyperinflationary. So at this point, the widest and deepest market, this, and we looked a couple of videos ago at gold, these very wide and deep markets are not signaling a hyperinflationary collapse. Now, maybe the markets are wrong. And if they're wrong and you're right, you can buy tips and buy gold. And if you turn out to be right, that will have been a very smart move probably because there are hedges against that. But as of now, the markets are poised for risk. That risk may be hyperinflation. No, they're not poised for hyperinflation. Okay, let's go on in the data and see what the actual inflation has been. Very high, but not hyperinflation high. 8.5% is high over a year, but hyperinflation is 100%, 1,000%, the kind of thing we've seen with Zimbabwe or Venezuela. We don't have a hyperinflationary situation yet. And as you saw in a previous video, actually month to month is coming down a little bit. Not much, still high. The inflation story is not over yet, that's clear. But hyperinflation, not so far. And even this is year over year. But if we look at monthly core, we see that it actually has been coming down lately. Okay, so let's go to the reason that I think that we're not going to get hyperinflation or not anytime soon. Inflation comes from dollars circulating, chasing goods. So too many dollars chasing too few goods. All right, but let's stop for a second. Too many dollars where? Well, they have to be here in the United States in order to cause inflation in the United States. They have to be domestic. The problem is the dollar's been strengthening against other currencies. It tends to happen when there's a global crisis. The dollar is still considered a haven asset. So a lot of our dollars are overseas. Now that's a risk if they came back. That would be inflationary, but there's been enough demand for dollars that's pulled them overseas. So if they're not here, they're not causing inflation. Also, the dollars have to circulate. Well, here. Let's look at the dollars that are in the vaults of America's largest banks. This is reserves. See how high reserves are according to history? Very, very high. Now, they've come down a little bit lately. So it's kind of like, think of it this way. Banks have a certain amount of money that they want to hold. Oh, I want to pass my stress test. Otherwise, I'm going to be in trouble. So they kind of fill up on dollar reserves. They put a lot of money in the vault because the stress testers are coming and they don't want to get in trouble. And then they kind of get a sense, oh, the stress tests maybe aren't so bad, so they take some of the money out of the vault. Then they're concerned about COVID. Will the regulators put us under stress tests again? Can we survive the COVID coma and the shutdown of the economy? So they start to reserve more. And they also are maybe a little bit afraid to lend out because they don't know what the economic outlook is. And so it's like a bucket filling up with water. The central bank keeps pumping water out, keeps pumping money. And a lot of people say, this is hyperinflationary. Well, it doesn't cause a flood until the bucket's full. Now, the water's been going in here, but there hasn't. But from here, except for here, from here to here, no inflation. Why? See, because this is so high. The money is not going out into the general economy. It's in the bank vaults. By the way, I should also point out that the government, that the central bank, now pays banks to hold on to the money. They pay interest on this. So the banks can make money by just holding money in their vaults. So that's an incentive for them not to lend to the rest of us. But based on different conditions, there's a kind of a bucket, a certain amount they want. And when that bucket gets full and the money supply keeps increasing, the pump keeps going, the hose is still turned on, eventually it spills out. And when it spills out, that's inflationary. But look, yes, it spilled out, but look how high it is compared to history. A lot of money is being held by banks in reserves. They're just holding it, and if it doesn't circulate, it's not inflationary. If it's overseas, it's not domestic inflation. So until there's a dollar crisis where the dollars come back from overseas, or until something happens where banks are maybe a little less regulated or a little less frightened, or the central bank stops paying them interest to not lend to the rest of us, at that point the money stays kind of locked up. Does that prevent inflation? No, clearly it doesn't. We've had high inflation. But it means that you get less inflation than you would expect if you just looked at money supply increases. And a lot of people from 2008 and 9 afterwards have just terrified people with predictions about the imminent hyperinflation because of all the money supply increases. And they didn't pay attention to the fact that the money supply isn't what determines inflation. Circulating domestic money supply is what determines circulating domestic inflation. If it's in vaults in banks or it's held overseas, it's not inflationary here and won't be until it's released. Now, when that happens, then we've got a serious problem. How do we hedge against that serious problem? Well, we'll talk about that in a future video. In the meantime, thank you very much for watching Eagle Investing Network. I'm Jerry Bowyer. Oh, don't forget, hit subscribe.